Welcome back to the Daily Crypto Roundup Deep Dive. If you're new here, hit follow now. Because today, we're unpacking one of the biggest questions in the entire financial world. The $10 trillion question. Can crypto, led by Bitcoin, actually replace gold as the world's preferred store of value? It's not a meme question anymore. It's a serious debate happening inside investment committees, hedge funds, and central banks. Gold has ruled as humanity's ultimate safe haven for 5,000 years. But for the first time ever, it's facing a rival that's not dug out of the ground, but mined from code. A digital asset designed for scarcity, portability, and trust in math rather than governments. The idea that Bitcoin could take gold's crown used to sound like fantasy. But the data coming in from the ETFs, the macro environment, and the institutional flows all say this. That shift is already beginning. Let's break it down. Gold's market capitalization today sits around $10.5 trillion. It's enormous, bigger than the GDP of Japan. But while it has history and prestige, it's also stagnating. In 2024 and 2025, gold ETFs have seen net outflows in 7 of the last 9 months, according to Bloomberg Intelligence, totaling nearly $20 billion. Investors are quietly pulling exposure from physical metal funds and rotating that capital into digital scarcity. The biggest proof? Bitcoin ETFs have seen roughly $18 billion of net inflows since approval in early 2024. In other words, for every dollar leaving gold, almost $1 is entering Bitcoin. Fidelity calls it a generational rotation. Not speculation, but reallocation. Bitcoin, unlike gold, doesn't rely on vaults, logistics, or middlemen. It moves across borders at the speed of light, and it's not controlled by any single entity. Fidelity's director of global macro, Jurrien, put it simply in a note last week. Bitcoin is behaving more like digital gold than a risk asset. Its volatility profile is converging with commodities, while its supply structure remains uniquely constrained. That statement from one of the oldest and most conservative asset managers in the world is powerful. They're not dismissing Bitcoin anymore. They're modeling it. Gold's outflows are being accelerated by one more structural force, ETFs. When the first gold ETF launched in 2004, it was revolutionary. It made gold easy to buy without owning bars or coins, and it triggered a massive bull run for the next 7 years. Now Bitcoin is replaying that exact moment, but at internet speed. The Bitcoin ETFs from BlackRock, Fidelity, ARK, and Bitwise have turned crypto from a niche market into an accessible investment vehicle for pensions, institutions, and family offices. BlackRock's iShares Bitcoin Trust alone has gathered over $16 billion in assets under management in less than a year. For perspective, it took SPDR Gold shares more than 3 years to reach that number. Gold's defenders argue that the metal still has something Bitcoin doesn't, a track record of surviving every regime, every collapse, every default. And that's true. But the counterpoint is simple. History alone doesn't protect purchasing power. Since 2011, gold has underperformed equities, real estate, and now even US Treasuries. In inflation-adjusted terms, it's flat. Bitcoin, over the same period, is up over 10 million% from its genesis block. It's not a fair comparison. Gold had 5 millennia to build trust. Bitcoin's had 15 years. But the growth curve speaks for itself. So how realistic is the idea that Bitcoin can replace gold? Let's run the numbers. Gold's total market cap is about $10.5 trillion. Bitcoin sits near $2.5 trillion at today's prices. That means Bitcoin would need to grow about 4 times to achieve parity. If that happened, you're looking at roughly $500,000 per coin. But even partial capture changes everything. At 25% of gold's cap, Bitcoin would trade around $125,000, a level it's already flirting with. At 50%, that's roughly $250,000. Full parity puts it in the $500,000 range. And those aren't fantasy scenarios anymore. They're probability curves being run by institutional models. Another reason analysts think it's possible is the macro backdrop. Governments everywhere are drowning in debt. Interest payments are exploding. And the only way to keep the machine running is by printing more money. That's not a political view. It's arithmetic. The US debt now exceeds $35 trillion, and deficits are locked in at levels that make austerity politically impossible. That's the same environment that powered gold's legendary bull run in the 1970s. Back then, inflation and distrust in fiat currencies made hard assets the safe haven. The difference now is generational. Millennials and Gen Z don't buy gold bars, they buy digital assets. Bloomberg's senior strategist Mike McGlone summed it up this week. Bitcoin is replacing gold as the 21st century reserve asset for individuals. He added that scarcity is going digital, and the market is voting with its capital. That phrase, the market voting with its capital, is exactly what's happening in ETFs. In just 9 months, Bitcoin ETFs have taken in nearly as much as gold ETFs have lost in 3 years. That's the rotation in real time. Gold's physical constraints, once its strength, are now its bottleneck. It's heavy, hard to move, and costly to verify. Bitcoin is the opposite. Lightweight, borderless, instantly auditable. Every Satoshi ever created is visible and traceable on-chain. You can't fake supply, you can't inflate it, and you don't need armored trucks to transport it. That's not just convenience. It's a new kind of trust. Institutional analysts like Fidelity's Jurrien are also noting how Bitcoin's volatility is shrinking as liquidity deepens. Early Bitcoin was wild. 50% swings were normal. Now, the standard deviation of daily returns has converged closer to gold's in several multi-month periods. In plain English, Bitcoin is growing up. It's still volatile, but no longer uninvestable. And that's a key milestone in every asset's maturity journey. Even the risk arguments are evolving. People used to say Bitcoin has no intrinsic value, but neither does gold in a functional sense. Its value is belief, scarcity, and energy cost. The same 3 pillars Bitcoin now owns digitally: energy, scarcity, and belief. That's the trifecta of store of value assets. And yet, there's a deeper psychological factor too: portability. You can't walk through an airport with $1 million in gold. You can carry it in Bitcoin in your mind, protected by 12 words. That kind of sovereignty is completely new in monetary history. Gold could make you rich, but it couldn't make you free. Bitcoin can do both. Now, before we go further, this is where I want to pause for a quick but crucial reminder. If Bitcoin and crypto are your store of value, then custody isn't optional. It's the whole point. This is why I keep my long-term holdings on a Ledger hardware wallet. It's offline, tamper-proof, and under my control. No exchange hacks, no counterparty risk, no middlemen. If you believe in scarcity and self-sovereignty, you can't leave your assets in someone else's custody. Whether you hold one coin or a fraction, protect it the way gold investors protect a vault. There's a link in the description if you need one. Take this as your sign to secure what you've built. Now back to our main question. Can Bitcoin replace gold? The answer might depend less on Bitcoin and more on human behavior. Trust evolves. In the 1800s, people trusted banks over gold. In the 1900s, they trusted governments over banks. In the 2000s, they're starting to trust code over governments. Each step replaced one layer of belief with another. Gold served a world that valued physical security. Bitcoin serves a world that values informational security. There's also a generational rotation happening inside finance itself. Fidelity's internal surveys show that 70% of investors under 35 now prefer Bitcoin to gold as a long-term store of value. Among those over 60, gold still dominates. But demographics don't lie. Wealth transfers down the line. As the next generation inherits assets, they're reallocating into what they understand. In that sense, the flippening between Bitcoin and gold isn't a trade, it's a demographic inevitability. The geopolitical layer also matters. Central banks have been buying record amounts of gold, over 1,000 tons in 2024, as a hedge against currency weaponization and sanctions. But even there, cracks are forming. Several sovereign wealth funds and small central banks are quietly exploring Bitcoin exposure, either directly or through ETFs, as a secondary reserve asset. If even a handful of those entities start treating Bitcoin as a micro-reserve, that's another structural bid under price. And remember, gold's rally in the 1970s wasn't driven by traders. it was driven by policy failure. Inflation, debt, and distrust fueled the move. The parallels now are uncanny. Same inflationary fears, same monetary overstretch, same loss of confidence in political restraint. But this time, there's an alternative that's faster, harder, and global. That's why analysts call Bitcoin the millennial gold. One more metric drives this home. Glassnode data shows that nearly 75% of all Bitcoin supply hasn't moved in over 6 months. That's the highest level of long-term holder conviction ever recorded. Compare that to gold ETFs, where turnover is constant. Bitcoin holders are treating it like gold already, a long-duration store of value, not a speculative chip. So what would the world look like if Bitcoin actually did replace gold? Start with liquidity. Bitcoin would become a new form of collateral for the digital age. It would underpin global lending, payments, and derivatives just as gold-backed paper once did. Treasury managers would allocate small but steady percentages to it. And over time, it could evolve from a risk asset into the base layer of a new kind of financial system. Decentralized, programmable, and borderless. Of course, this transition won't happen overnight. Gold isn't disappearing. It still plays a role as a tangible hedge, and jewelry demand will always support a baseline. But the dominance is shifting. Bitcoin doesn't need to destroy gold to win. It just needs to coexist while absorbing capital that's chasing performance and efficiency. So, can crypto replace gold? If you define replace as render irrelevant, maybe not. But if you define it as supersede in utility, liquidity, and future growth, then yes, the replacement is already underway. Bitcoin is becoming the reserve asset of the digital world, the same way gold was for the physical one. The charts tell the story, but so does the behavior. Gold's inflows are slowing. Bitcoins are accelerating. Wealth is rotating from matter to math. When you zoom out, this isn't just about price. It's about what humanity trusts to hold value. For centuries, we trusted the earth. Now we're starting to trust the algorithm. And that shift, from physical scarcity to digital, may be the most important financial evolution of our lifetime. That's today's deep dive. The $10 trillion question. Can crypto replace gold? The answer is unfolding in real time. Keep your eyes on the flows, keep your stack secure, and keep your conviction measured. Follow the show for tomorrow's update. And as always, we will see you at the top.